Hi, welcome back to Concierge CPA. I am Juliet. Today's video is the second in the GAAP series. In part one, we broke down the big picture of GAAP. We talked about what GAAP is, why it exists, and who it's for. We also went over 5 key concepts within GAAP that must be followed when recording transactions. And we briefly introduced the 10 key principles of GAAP. Now, in part 2, we are digging into those 10 core principles that form the foundation of GAAP. I'm going to walk you through each one step by step and show you what they look like in real life. Because let's be honest, it's one thing to memorize a definition, but it's another to actually see how these rules apply in everyday accounting decisions. Before we dive in, let's take a quick second to recap what GAAP is. GAAP, which stands for Generally Accepted Accounting Principles, is a standardized set of rules and guidelines that govern how financial statements are prepared and reported in the United States. These principles are designed to ensure consistency, transparency, and comparability across companies so that investors, regulators, and other stakeholders can trust the numbers. GAAP is developed by the Financial Accounting Standards Board, FASB, and enforced by the SEC for publicly traded companies. Think of it as the grammar of accounting. If you're not following GAAP, you are not speaking the language right. These principles aren't just abstract. They are what makes financial statements work. They guide how revenue is recognized, how expenses are reported, and how companies present their financial health to the world. All right. Enough background. Let's get into the core of this video. Principle number 1, regularity. Stick to the standards. Now, this principle is all about playing by the rules. It means that as accountants, we are expected to follow GAAP standards consistently and fully. No shortcuts, no creative reinterpretations, no cherry picking the rules we like and skipping the ones we don't like. It's kind of like using a recipe. If you're baking a cake and it calls for 2 eggs, you don't just throw in 4 because you feel like it. Following this recipe gives you predictable results. Same with accounting. GAAP is the recipe. If everyone follows it, we can trust the outcome. So here is a real-world example. Let's say you're working at a mid-sized tech company and it's year-end close time. There's pressure from the CFO to hit aggressive earnings targets before the board review. Instead of applying conservative revenue recognition rules, someone suggests accelerating revenue, maybe booking income from next quarter's subscription renewals now to help the numbers. That's a clear violation of regularity. You can't just bend the rules because the company wants to look better on paper. This principle exists to ensure every accountant follows the same standards, even under pressure. Without it, financial statements would lose all credibility and investor trust will go out the window. Principle number 2, consistency. Choose a method and stick with it. The second GAAP principle is consistency, and it's all about stability over time. In accounting, consistency means that once you adopt a specific accounting method, whether it's how you depreciate assets, recognize revenue, or categorize expenses, you keep using that method from one period to the next. Why? Because it allows people reading your financials to compare results year over year and actually make sense of the trends. Principle number 3, sincerity. Be honest about the numbers. The third GAAP principle is sincerity, and at its core, it means this. Accountants are expected to be truthful and objective in the way they present financial information. No spin, no sugarcoating, no massaging the numbers to make things look better than they are. This principle is what gives financial statements their integrity. If the information isn't honest, the whole system falls apart because every user of those financials is relying on the assumption that the numbers reflect reality. So let's say a company is struggling, sales are down, expenses are climbing, and profitability isn't looking great. The pressure from leadership is real, and there might be even a temptation to defer recognizing certain expenses or to count revenue early just to dress up the financials. But under the principle of sincerity, that's not acceptable. Accountants have a duty to present a fair and accurate picture of the company's financial position, even when the numbers aren't flattering. Whether you're reporting to investors, banks, auditors, or tax authorities, the information must reflect the company's actual economic reality. So here's the bottom line. Sincerity is about professional ethics. It's about telling the financial truth, even when it's inconvenient. And it's what separates trustworthy reporting from manipulation. Principle number 4, permanence of methods. Keep the reporting structure consistent. The fourth GAAP principle is permanence of methods, and it's all about consistency in how financial information is presented and classified from one period to the next. This principle is often confused with the principle of consistency, but here's the difference. Consistency is about sticking with your accounting methods, like how you calculate depreciation or inventory. Permanence of methods is about the structure of your financial reports, how you organize, label, and classify information so that it's easy to understand and compare over time. Let's look at an example. Let's say a company has always reported its operating expenses using functional categories like research and development, selling, and general administrative. But this year, they decide to switch to natural classifications, reporting them as salaries, utilities, travel, etc., without any disclosure or explanation. Even if the dollar amounts haven't changed, the presentation has, and that disrupts comparability. That shift in reporting style without transparency is a violation of the permanence of methods principle. GAAP expects companies to keep the reporting layout consistent over time or clearly explain any changes so that users of financial statements aren't left guessing or struggling to compare year-over-year results. So here's the bottom line. Financial statements aren't just about numbers. They are about clarity. Permanence of methods ensures that how you report information remains stable, so your financial story is consistent, comparable, and easy to follow from one year to the next. Principle number 5, non-compensation. Don't hide one thing behind another. The fifth GAAP principle is non-compensation, and it's all about financial transparency. This principle says you should report all aspects of a financial position separately and in full. You can't offset a liability with an asset or an expense with income just to make things look better. In other words, no netting to hide the ugly stuff. Financial statements need to show the whole picture, not just the net result of good and bad. Readers deserve to see both sides of the story clearly and independently. So here's an example. Let's say your company is owed $80,000 from a customer. That's an asset, accounts receivable. But you also owe that same customer $50,000 for services they provide. That's a liability, an accounts payable. You might be tempted to just report the $30,000 net difference and move on, but under the principle of non-compensation, you can't do that. You must report the $80,000 receivable and the $50,000 payable separately. Why? Because netting those numbers hides valuable details. An investor or lender might see the $30,000 net and think your cash position is stronger than it really is. This principle also applies to revenue and expenses. You can't offset losses in one area with gains in another to make performance look smoother. GAAP requires full disclosure so financial statements reflect both the risks and the rewards. So the bottom line is, non-compensation keeps financial reporting honest. It prevents companies from masking liabilities or overstating performance by sweeping things under the rug. Clear, separate reporting, trustworthy financials. Principle number 6, prudence. Conservatism. Don't overhype the numbers. This principle is about being careful, realistic, and grounded when reporting financial results. This principle says you should never overstate assets or income, and you shouldn't underestimate liabilities or expenses. The idea is to present a picture that leans slightly on the cautious side, especially when there's uncertainty involved. Think of it this way. If there is a potential risk or loss down the road, you plan for it now. But if there is a potential gain, you wait until it's actually earned. GAAP wants you to avoid wishful thinking when it comes to your financials. So here's an example. Let's say a customer who owes your company $100,000 is starting to struggle financially. They haven't defaulted yet, but there is a good chance they might. Under the principle of prudence, you don't wait until the customer officially goes bankrupt to take action. You set up an allowance for doubtful accounts now, because there is a real risk you won't collect the full amount. On the flip side, maybe your company is in line to win a big lawsuit or land a major contract. It's tempting to count that money early, but under GAAP, you can't record any of it until the income is earned or the judgment is finalized. So the bottom line is, prudence keeps financial statements grounded in reality. It prevents companies from painting an overly optimistic picture and ensures that financial reports reflect known risks, even if they haven't hit yet. That level of caution helps protect stakeholders and maintains credibility when uncertainty is in play. The seventh GAAP principle is continuity, also known as the going concern principle. This one is about assumption. Specifically, the assumption that the business will continue to operate for the foreseeable future, unless there is solid, documented evidence that a company is shutting down. GAAP requires you to prepare financial statements as if the business will keep running. This principle is essential because it directly impacts how we value assets and liabilities. If a business is expected to keep operating, accountants can use historical costs when recording assets, rather than adjusting to liquidation values. Think of it this way. If a company is going through a rough patch, maybe sales are down or leadership is making cuts, that doesn't automatically mean it's shutting down, as long as the business is expected to recover and continue operating. Financial reporting stays on course using normal assumptions. Here's an example. Let's say a company is dealing with declining profits and restructuring. Even with those challenges, if there is no serious doubt about its ability to continue, the company's financial statements will still reflect long-term operations, meaning no sudden markdowns or liquidation adjustments. However, if it becomes clear that the business may not survive much longer, say it's closing locations, defaulting on debt, or planning to dissolve, that's when disclosures need to reflect that shift. Investors and stakeholders need to know the full picture. So here's the bottom line. Continuity ensures that financial statements reflect ongoing operations, not panic or speculation. It provides the stability in how companies report their financial position, while still requiring transparency if the future of the business is at risk. Principle number 8, periodicity. Report in consistent time intervals. The periodicity principle says that a company's financial performance should be reported in standard, consistent time periods, like months, quarters, or fiscal years. This structure allows stakeholders to assess how the business is performing over time. By dividing financial activity into defined intervals, companies can provide timely, relevant information that supports meaningful comparisons and better decision-making. So here's a real-world example. Public companies are required to issue quarterly reports, 10Qs, and annual reports, 10Ks, to show how they are performing during those specific periods. These reports include income statements, balance sheets, and cash flow statements, all tied to a set time frame. That structure allows investors, regulators, and management to compare one period results to the next, track trends, and understand changes in financial health and performance. So the bottom line is, periodicity brings rhythm and structure to financial reporting. It ensures that data isn't just reported at random, it's delivered consistently in regular intervals, so stakeholders always have a current and clear view of the company's financial status. Principle number 9, full disclosure. Tell the whole story. The full disclosure principle requires companies to include all relevant information in their financial statements, especially anything that could influence decisions made by investors, lenders, or other stakeholders. This isn't just about the numbers. It's about providing context, clarity, and transparency. That includes disclosing events, risks, or obligations that aren't always obvious in the financial statements themselves, often through footnotes or supplementary schedules. Let's say a company recently signed a major long-term lease agreement for a new corporate headquarters. Even if the lease hasn't started yet and the payments won't begin until next year, the company must disclose the terms of the lease in the footnotes, because it represents a significant future obligation that affects the company's financial outlook. Other examples of full disclosure include pending debt maturities, changes in accounting policies, significant acquisitions, or executive compensation agreements. So here's the bottom line. The full disclosure principle ensures stakeholders get the whole picture, not just the numbers, but the story behind them. It builds trust and helps users of financial statements make informed decisions based on facts, not assumptions. And finally, principle number 10, utmost good faith. Operate with honesty and integrity. The final GAAP principle is utmost good faith, and it's exactly what it sounds like. Honesty and transparency should be at the core of every financial transaction and report. This principle is rooted in the idea that everyone involved in the financial reporting process, management, accountants, auditors, and even third-party consultants, should act with integrity and fairness. It's about being straightforward, ethical, and trustworthy in how financial information is handled and shared. So here's a real-world example. Let's say a company is applying for a bank loan. It would be easy to hold back certain liabilities or overstate projected earnings to improve their chances of approval. But under the principle of utmost good faith, that kind of misrepresentation isn't just unethical, it undermines the entire purpose of financial reporting. The same applies when disclosing risks to investors, responding to audit inquiries, or preparing financial statements. The numbers may be accurate, but if the information is intentionally withheld or presented in a misleading way, it violates the principle. So here's the bottom line. Utmost good faith is the ethical foundation of accounting. It ensures that financial information is not just technically correct, but morally sound. Trust is everything in financial reporting, and this principle is what holds that trust together. And that wraps up the 10 core principles of GAAP. These principles aren't just accounting theory. They are the rules and values that keep financial reporting honest, consistent, and useful. They shape how companies recognize revenue, record expenses, present performance, and tell the full story behind the numbers. Most importantly, they help build trust between businesses and investors, between accountants and auditors, and between financial reports and the people who rely on them. If you enjoyed this video and learned something new about accounting, don't forget to like, share, and subscribe to the channel for more practical, real-world accounting knowledge. Thanks for watching, and I will see you in the next one.